In this video, we'll be discussing interpretation and analysis of the financial statements and how your financial statements contain the information you need to help make decisions regarding your business. Many small business owners think of their financial statements as requirements for creditors, bankers, or tax preparers only, but they are much more than that. When analyzed, your financial statements can give you key information needed on the financial condition and the operations of your business. Financial statement analysis involves the studying of relationships and comparisons of 1. Items in a single year's financial statement, 2. Comparative financial statements for a period of time, and 3. Your statements with those of other businesses. There are many analytic tools available, but this video will focus on the following measures that are of most importance to a small business owner in the business planning process: liquidity analysis, profitability analysis, measures of debt, measures of investment, vertical financial statement analysis, horizontal financial statement analysis. Before discussing financial statement analysis, let's do a quick recap on what is a balance sheet and an income statement. What is a balance sheet? The balance sheet is a financial statement that shows the financial position of the business as of a fixed date. It is usually done at the close of an accounting period. The balance sheet can be compared to a still photograph. It is a picture of what your business owns and owes at a given moment and will show you whether your financial position is strong or weak. By regularly preparing this statement, you'll be able to identify and analyze trends in the financial strength of your business and thus implement timely modifications. The three categories, assets, liabilities, and net worth, are related in that at any given time, a business's assets equal the total contributions by its creditors and owners. Assets equals anything your business owns that has monetary value. Liabilities equals debts owned by the business to any of its creditors. Net worth, or capital, equals an amount equal to the owner's equity. The relationship among these three terms is simply illustrated in a mathematical formula: assets minus liabilities equals net worth. What is a profit and loss or income statement? This statement shows your business financial activity over a period of time, usually your tax year. In contrast to the balance sheet, which shows a picture of your business at a given moment, the profit and loss statement, or P&L, can be likened to a moving picture, showing what has happened in your business over a period of time. It is an excellent tool for assessing your business. You'll be able to pick out weaknesses in your operation and plan ways to run your business more effectively, thereby increasing your profits. For example, you may find that some heavy advertising that you did in March did not effectively increase your sales. In following years, you may decide to utilize your advertising funds more effectively by using them at a time when there is increased customer spending taking place. In the same way, you might use your P&L statement to see what months have the heaviest sales volume and plan your inventory accordingly. Comparison of your P&Ls from several years will give you an even better picture of the trends in your business. The P&L statement or income statement is compiled from actual business transactions in contrast to pro forma statements, which are projections for future business periods. The P&L shows where your money has come from and where it was spent over a specific period of time. It should be prepared not only at the end of the tax year, but at the close of each business month. It is one of the two principal financial statements prepared from the ledgers and the records of a business. Let's take a look on the next several slides at some ratios that may help you to evaluate your business. To illustrate, I will use the following balance sheet and income statement from your business company to see the financial condition of your business. Liquidity analysis. The liquidity of a business is the ability it has to meet financial obligations. The analysis focuses on the balance sheet relationships for the current assets and current liabilities. Net working capital. The excess of current assets over current liabilities is net working capital. The more net working capital a business has, the less risky it is, as it has the ability to cover current liabilities as they come due. In this example, in year 2017, your current asset is $9,000. It is highlighted in blue on the balance sheet. Subtract your current liability of $2,300 and your net working capital is $6,700. Same thing for year 2018. In both years, net working capital was present, which would indicate a good position. But let's analyze this a bit more to get a clear picture of the liquidity of your business. The current ratio is a more dependable indication of liquidity than the net working capital. The current ratio is computed with the following formula. Current ratio equals current assets over current liabilities. For your business, the current ratios are, in 2017, $9,000 over $2,300 equals 3.91. In 2018, $10,000 over $4,220 equals 2.37. As you can see, the business was in a more liquid position in 2017. In 2018, the business did experience an increase in current assets, but it also had an increase in current liabilities. There is no set criteria for the normal current ratio, as that is dependent on the business you're in. If you have predictable cash flows, you can operate with a lower current ratio. The ratio of 2.0 is considered acceptable for most businesses. A ratio of 2.0 would allow a company to lose 50% of its current asset and still be able to cover current liabilities. For most businesses, this is an adequate margin of safety. For your business, the decrease in the current ratio would cause the owner to investigate further, even though 2.37 is acceptable for the current year. Quick ratio. Since inventory is the most difficult current asset to dispose of quickly, it is subtracted from the current assets in the quick ratio to give a tougher test of liquidity. The quick ratio is computed as follows. Quick ratio equals current assets minus inventory over current liabilities. The quick ratios in this example are 2017, $9,000 minus $3,000 over $2,300 equals 2.61. In 2018, $10,000 minus $5,000 over $4,220 equals 1.18. A quick ratio of 1.0 or greater is usually recommended, but that is dependent on the business you're in. From the analysis of the liquidity measures, net working capital, current ratio, and quick ratio, the 2018 results are within acceptable limits. The business did experience a decrease in liquidity and is viewed as more risky than in 2017. You can use these ratios to see if your business is in any risk of insolvency. You will also be able to assess your ability to increase or decrease current assets for your business strategy. How will these moves affect your liquidity? Your creditors will use these ratios to determine whether to extend credit to you. They will compare the ratios for previous periods and with those of similar businesses. Profitability analysis. A profitability analysis will measure the ability of a business to make a profit. Gross profit margin. The gross profit margin indicates the percentage of each sales dollar remaining after a business has paid for its goods. Gross profit margin equals gross profit over sales. The higher the gross profit margin, the better. In this example, the gross profit margins were 2017, $2,100 over $6,000 equals 35%. In 2018, $2,000 over $8,000 equals 25%. The normal rate is dependent on the business you're in. The gross profit margin is the actual markup you have on the goods sold. In 2018, this example has a 25% contribution margin, which means that 25 cents of every dollar in sales is left to cover the variable, fixed, and other expenses. In 2017, there had been a 35% contribution margin or 35 cents of every dollar in sales left to cover those expenses. So your business can be viewed as less profitable in 2018 as compared to 2017. Operating profit margin. This ratio represents the pure operations profits, ignoring interest and taxes. A high operating profit margin is preferred. Operating profit margin equals income from operations over sales. This example has the following ratios. In 2017, $1,385 over $6,000 equals 23.08%. In 2018, $950 over $8,000 equals 11.88%. Again, this example is showing a less profitable position in 2018 than it did in 2017. Net profit margin. The net profit margin is clearly the measure of a business's success with respect to earnings on sales. Net profit margin equals net profit over sales. A higher margin means the firm is more profitable. The net profit margin will differ according to your specific types of business. A 1% margin for a grocery store is not unusual due to the large quantity of items handled, while a 10% margin for a jewelry store would be considered low. This example has the following net profit margins. 2017, $755 over $6,000 equals 12.6%. 2018, $80 over $8,000 equals 1%. Clearly, your business is in trouble. All the ratios indicate a significant decrease in profitability from 2017. The next step is to determine reasons for that decrease. As a business owner, you can see just how profitable your business is. If the ratios are too low, you will want to analyze why. Did you have enough markup on your goods? Check your gross profit margin. Are your operating expenses too high? Check your operating profit margin. Are your interest expense too high? Check your net profit margin. For your business, all of the above questions can be answered using the ratios computed. Your creditors will look at these ratios to see just how profitable your business is. Without profits, a business can't attract outside financing. Debt measures. The debt position of a business indicates the amount of other people's money that is being used to generate profits. Many new businesses assume too much debt too soon in an attempt to grow too quickly. The measures of debt will tell a business how indebted it is and how able it is to service the debts. The more indebtedness, the greater the risk of failure. Debt ratio. This is a key financial ratio used by creditors. Debt ratio equals total liabilities over total assets. The higher this ratio, the more risk of failure. In this example, the debt ratios are, in 2017, $10,300 over $14,000 equals 74%. In 2018, $14,200 over $18,000 equals 79%. The acceptable ratio is dependent upon the policies of your creditors and bankers. The rates of 79% and 74% are excessively high and show a very high risk of failure. Clearly, 3/4 of the company is being financed by other people's money, and it does not put the business in a good position for acquiring new debt. If your business plan includes the addition of long-term debt at a future point, you will want to monitor your debt ratio. Investment measures. As a small business owner, you have invested money to acquire assets, and you should be getting a return on these assets. Even if the owner is taking a salary from the business, he or she also should be earning an additional amount for the investment in the company. Return on investment, or ROI. The ROI measures your effectiveness as a business owner to generate profits from the available assets. ROI equals net profits over total assets. The higher the ROI, the better. The business owner should set a target for the ROI. For your business, the ROI is as follows. 2017, $755 over $14,000 equals 5.4%. 2018, $80 over $18,000 equals 0.4%. We do not know what your business's target for ROI, but 0.4% would seem unacceptable. You could put your money in a savings account and earn 4%, so it doesn't appear that a 0.4% return on your investment is good. Many small business owners have successfully created jobs for themselves, but still don't earn a fair return on their investment. Set your target for ROI and work towards it. Vertical financial statement analysis. Percentage analysis is used to show the relationship of the components in a single financial statement. For a balance sheet, each asset is stated as a percent of total assets, and each liability and equity item is stated as a percent of total liabilities and equity. For an income statement, in vertical analysis of the income statement, each item is stated as a percent of net sales. Here is an example of a vertical analysis of the income statement. Evaluation of vertical financial statement. From the vertical analysis of your business's income statements, you can see the following. Number 1, the components of cost of goods sold and gross profit show significant differences. Cost of goods sold increased from 65% of sales to 75% of sales. This should alert the owner to investigate. Did the cost of the item really increase and the selling price stay the same? Is there a possibility of theft that may have caused the variance? The decrease in gross profit margin from 35% of sales to 25% of sales should also trigger the owner to look at the markup. Is the markup too low? Will your customers still buy if you raise the selling price on your products? Number 2, the composition of variable changed. The owner would want to evaluate the appropriateness of the increase in advertising and decrease in salaries. Number 3, the composition of fixed expenses would alert the owner to evaluate the increase in rent. Why did this occur? Is it necessary or are there other alternatives? Number 4, the increase in interest should be analyzed. The most likely reason for the increase would probably be an increase in debt. Horizontal financial statement analysis. Horizontal analysis is a percentage analysis of the increases and decreases in the items on comparative financial statements, example, balance sheets or income statements. The increase or decrease of the item is listed, and the earlier statement is used as a base. The percentage of increase or decrease is listed in the last column. Here is an example of a horizontal analysis of the income statement. Evaluation of horizontal financial statement analysis. From the horizontal analysis of your business's income statements, you should evaluate the following. Number 1, the 33.3% increase in sales resulted in only a 4.8% increase in gross profit. This would alert the owner that something was wrong. Is the markup sufficient? Number 2, the 100% increase in advertising expense was steep. Did this expense increase sales? Was it justified? Number 3, the 80% rent increase and 50% utilities increase should be looked at. Are these increases justified? Number 4, the 60% interest increase is most likely a result of increased debt. The owner would want to analyze the components. Decide if the interest level is correct. Decide if some debt should be retired. Number 5, the 89.4% decrease in net profit is not acceptable. A serious decrease will require that the owner reevaluate the business. Now you can see how financial statement analysis can be a tool to help you manage your business. If the analysis produces results that don't meet your expectations, or if the business is in danger of failure, you must analyze your expenses and your use of assets. Your first step should be to cut expenses and increase the productivity of your assets. If your return on investment is too low, examine how you could make your assets, equipment, machinery, fixtures, inventory, etc., work better for your benefit. If your profit is low, be sure that your markup is adequate. Analyze your operating expenses to see that they are not too high, and review your interest expenses. If your liquidity is low, you could have a risk of becoming insolvent. Examine the level and composition of current assets and current liabilities. The vertical and horizontal financial statement analysis will reveal trends and compositions that signify trouble. Using your management skills, you can take corrective action.